How's it going, everyone? So I want to show you a strategy that's very, very simple in its concept, but on the other hand, it's also very logical. So I've backtested this strategy, okay? It's called First Fair Value Gap version 3. We can run it again just to see that these are indeed the results of this strategy. I backtested it on the NASDAQ using 1-minute candles. I tested it for about 4 months because 1-minute candles simply require a relatively large amount of computing power. I don't want my computer to work too hard right now. This is basically the profit over time as shown here. You can also see some additional statistical data on this strategy. For example, its profit factor, its maximum drawdown, how many trades it produced in total, the average number of trades per day, the win percentage, the risk to reward ratio, and so on. Basically, I can go into the chart, right, and actually see exactly where the strategy entered and also precisely where the strategy exited, which is really, really very, very nice because it also genuinely helps me visually confirm that my strategy did indeed enter and exit in the places I expected it to. Where the strategy basically entered a trade for me here. Basically, the price came from above down into the fair value gap, and of course, when it touched it, I entered a long position here. Okay, my take profit was set right here. My stop loss, I believe, was placed somewhere around this area. Basically, I take both profits and losses based on the current volatility present in the market. Okay? Basically, our volatility changes. For example, the American session tends to have typically more volatility and volume, while the Asian session has less volatility and volume. Okay? So I want my strategy to adapt itself, its trade management, to the volatility in the market. Okay? That's very important. Here's another example where my strategy lost, for instance. I went long here because the price came from top to bottom. I entered a long position and it stopped me out of my position here. Then it came from the bottom up. I entered a short and it stopped me out here as well. An example of a successful trade. Another example of a successful trade. An example of an unsuccessful trade. An example of a successful short trade. And so on. Now, what's so special about this particular strategy that makes it so remarkably simple? As you can see, there are absolutely no indicators here. There's no RSI, and there are no moving averages at all. There's nothing else. There's only one thing, and that's this fair value gap. And it's just one fair value gap, which I only replace every 24 hours. What is it? Why did I choose this specific fair value gap? So I want to tell you something that I hope will change your mindset as traders. To show it to you, I just want to quickly bring up the volume indicator. Okay, now essentially what I want to do here is to look for the big fish in the market, the major players. I want to look for the big machines, the machines that really move the market. That's what I'm looking for. I want to find their signal and I want to find their unique footprint in the market. And then, after I have successfully found their footprint, I'll carefully mark it, and then I'll patiently wait for the price to return to that specific footprint. Okay? For me, that's the fundamental basis of my trading philosophy. I want to carefully identify the footprints left by the smart money in the markets. You can call it SMC, which stands for Smart Money Concept, or you can refer to it as ICT. I also want to identify the footprints of the big machines, the large institutional players. How do I identify them? So first, I want to see a certain recognizable pattern, okay? For example, this pattern can be an order block. This pattern can be a fair value gap, like I'm showing in this strategy. That's the first thing. The second thing, I want to see that this pattern is accompanied and supported by high trading volume. And generally, the higher the volume, the better. Okay, so now I'll show you why I specifically chose this fair value gap. Let's go to where this fair value gap was created. This fair value gap was created here. If you don't know what a fair value gap is, please search for fair value gap on Google. Basically, it indicates a certain imbalance, a specific imbalance, and it's reflected in the fact that there's a difference. For example, as you can see here, this is a bearish fair value gap. So there's a difference between the low and the high of this candle. This space that's created here, this void, indicates a strong imbalance, a big machine that pulled the market down. Now notice what's special about this fair value gap. What's special about it? Through volume. Okay, look, I just want to zoom out the screen for a second. Notice what low volume there was here and what high volume suddenly appeared here. Why? Why? The reason, first of all, is that price is a function of time. Okay, there are times the market is sensitive to, there are times that the technology, the machines, the algorithms are sensitive to. Okay, always remember this for your whole life. Price is a function of time. Okay, and this manifests in so many dimensions. But for our purposes, as you can see, really, why was this volume created? Because we are simply in the American session. Notice that at 9:30, okay? At 9:30 in the morning, New York time, what opens? The American session, right? Basically, all the heavy hitting machines of Wall Street have just opened. Great. Do you agree with me that a fair value gap accompanied by such high volume is much more powerful than just a fair value gap created with very, very low volume? Of course it is, right? Because we are also looking at volume. Now, this fair value gap basically tells me that there was a very, very big machine here that did this, a very big one. And I want to mark this area. I want to look for that footprint of the machine, find that footprint, mark it for the entire trading day, and wait for it there. That's exactly what I want to do. I want to carefully observe and see the footprints left behind by these large, powerful machines. And notice how the price just stays, lingers, and consolidates in this particular area. And every single time it comes to this area, each time it returns here, the market has reacted to it accordingly. Notice how many times this has happened. This is basically the first signal, this move we saw here, this is basically the first signal of the biggest machine that was there, okay? Because this fair value gap tells me there's a machine here that managed to create a downward imbalance. So for me, that's the machine, that's the footprint of the first machine in the American session that managed to push the market down and create an imbalance. Obviously, I'll want to keep this level marked, okay? That's the whole trick, that's the whole secret. Look again, there was actually a machine here, right? A fair value gap created with very, very high volume right after the American session, the start of the American session. Notice how many times the market simply returned to this place, and notice how many trading opportunities we could have taken here. This thing just repeats itself again and again. Every 24 hours, I want to find the fair value gap with the highest volume. There is nothing more momentary than that. You can see it here too. Now, for me, the main take-home message, the essential point that I really want you to take away is that you should always look for the very first traces of the fat machines. That's exactly what I want you to look for, okay? For me, this is the thing that will truly change all the rules of the game for you, making a real difference. You don't need to enter a trade because the RSI is at 30, okay? You don't need to enter into a deal just because the price has now reached its limit. No, that's exactly the brain of retail, really. I want you to make a deal with the smart money, with the fat money. And where will you enter? Where he performed for the first time? Notice what a simple strategy. The strategy is very, very simple, very simple. Every time there is a new price in the market, as you can see, my calculation here is based on price change. This means every time there is a change in price, this function receives a reading, And then I calculate things and make trading decisions. That's the whole strategy, friends. That's the whole strategy. Without any human touch and without anything else. And this is actually an okay result, not bad overall. I also started destroying it live. And just yesterday, it also brought me some really nice trades. And I will continue to destroy it live and I will update. Overall, things are looking good. But that's it. So I hope you, who took from me here the most important thing I wanted to convey to you, is that ultimately you need to find the traces of the fat fish in the market. That's the only thing I want you to take away from this video for life, okay? So thank you very much indeed. We'll meet again next time with more authentic and straightforward videos like this, where I will show you all sorts of indicators that I personally develop, various algorithms, and of course, manual trading. So thank you very much and have a nice day.